If you've ever wondered how to find penny stocks before they take off, this video is for you. We've all heard those stories. Someone puts a few dollars into a tiny stock and watches it skyrocket. It's the dream. But most penny stocks, they don't make it. They're cheap for a reason. Still, some do explode. And the real question is, how do you spot those ones early? Today I'm breaking down a step-by-step approach to help you identify penny stocks with real potential before the big move happens. So stick with me. By the end of this video, you'll know exactly what to look for. Before we jump into the strategy, let's clear up one big misconception. Most people hear penny stock and assume we're talking about stocks that literally trade for a few cents. But that's not always the case. A penny stock is any stock that trades for under $5 per share. And these are usually small companies that aren't listed on the big stock exchanges like the NYSE or NASDAQ. Instead, many of them trade on the OTC or over-the-counter markets, which are less regulated and more volatile. Because these stocks are so cheap, they can be incredibly tempting. You see a stock trading for 50 cents and you start doing the math. If this just goes to $5, I'd 10x my money. But that's where a lot of beginners go wrong. Not every low-priced stock is a hidden gem, and in fact, most of them won't take off. That's why you need a strategy to separate the potential winners from the ones that are just dead weight. If you want to find penny stocks with serious upside, you have to look at the industries they're in. Not all industries have the same potential for growth, and some sectors are naturally more explosive than others. Think about industries that are on the rise, things like electric vehicles, artificial intelligence, renewable energy, biotech, or cybersecurity. These are the areas where massive innovation is happening, and when a sector grows, the small companies within it have a much better chance of growing too. Let's take electric vehicles, for example. A few years ago, Tesla was dominating, but people were looking for the next Tesla. That led to a surge in smaller EV stocks, and many of them saw incredible gains. The same thing happened with biotech companies during the pandemic. Small pharmaceutical stocks that were working on vaccines or treatments saw massive spikes in value. So instead of just looking at individual stocks, start by identifying industries that are heating up. Pay attention to the news, government policies, and what big investors are putting their money into. When you find an industry that's gaining momentum, then start looking for promising penny stocks within that space. A lot of people make the mistake of buying penny stocks without checking their liquidity first. Liquidity simply means how easy it is to buy and sell shares of a stock. If a stock has very little trading volume, it means there aren't many buyers or sellers, and that can be a big problem. Imagine this. You find a penny stock trading for $1 and you buy 1,000 shares. You're feeling good about it, but then you try to sell, and there's nobody willing to buy. Now you're stuck holding shares that you can't sell unless you accept a much lower price. That's why you should always check the stock's volume before investing. Look for stocks where trading volume is increasing over time. If a stock was barely trading a few thousand shares per day but suddenly starts trading millions of shares, that's usually a sign that investors are starting to take notice. It doesn't always mean the stock is about to explode, but it does mean that interest is growing, and that's a positive sign. Now, I know that looking at financial statements might sound boring, but trust me, this step is crucial. Penny stocks are often risky because many of these companies aren't profitable yet, and some of them don't even have a real business behind them. If you're not careful, you could end up investing in a company that's basically just a name with no real operations. So what should you look for? First, check if the company is actually making money. A company with growing revenue is a good sign because it means their business is expanding. If their revenue is flat or declining, that's a red flag. Next, look at their debt. A little debt is fine, but if a company is drowning in debt and barely making any money, that's a disaster waiting to happen. Lastly, check their cash flow. If a company is burning through cash without any real source of income, they're going to run out of money eventually, which means they'll either go bankrupt or have to issue more shares, diluting your investment. One of the most powerful but often overlooked indicators in the stock market is insider buying. When we talk about insiders, we're referring to the people who run the company, CEOs, CFOs, board members, and other top executives who have access to confidential, behind-the-scenes information about the company's performance, strategy, and future prospects. Think about it. Who knows the company better than the people leading it? If a CEO or a key executive is using their own money to buy shares, it's a major green flag. It typically means they believe the stock is undervalued and that something positive is on the horizon. They wouldn't be risking their personal wealth if they weren't confident about the company's future. On the flip side, if insiders are selling off large amounts of stock, it might be a warning sign. Now, not all insider selling is bad. Sometimes executives sell for personal reasons, like buying a house or paying off debt. But if you notice a pattern of heavy insider selling, especially right before an earnings report or major announcement, you have to ask yourself, what do they know that the public doesn't? Stocks don't just rise in value randomly. There's always a reason behind a big move, and that reason is called a catalyst. A catalyst is simply an event or announcement that triggers a surge in stock price, and if you can identify one before it happens, you can position yourself ahead of the crowd. There are several types of catalysts that can send a stock soaring, and knowing what to look for gives you a major advantage. One of the biggest catalysts is earnings reports. When a company beats Wall Street expectations, its stock price can skyrocket. On the flip side, missing expectations can cause a sharp drop. Smart investors watch earnings calendars to anticipate these moves. Another major catalyst is a new product launch. If a company is about to release a highly anticipated product, like a new smartphone, AI software, or groundbreaking medical device, its stock could take off if the launch is successful. Major contracts and partnerships can also be game changers. If a small company suddenly lands a deal with a Fortune 500 giant or wins a government contract, that can completely change its financial outlook. Stocks often surge when news like this breaks. Regulatory approvals can also be a massive catalyst, especially for biotech and pharmaceutical companies. If a company is waiting for FDA approval on a new drug, the stock can explode overnight if it gets the green light. Investors who position themselves ahead of these decisions can see massive gains. Mergers and acquisitions are another huge factor. Rumors or official announcements of a buyout or merger can cause a stock to surge, as investors anticipate a premium buyout price. Finding penny stocks before they take off isn't about luck. It's about knowing what to look for and doing the right research. If you focus on growing industries, look for increasing trading volume, analyze financials, pay attention to insider buying, and watch for upcoming catalysts, you'll put yourself in the best position to catch the next big breakout stock. Remember, penny stocks are risky, so never invest more than you're willing to lose. But if you follow these strategies, you'll be miles ahead of the average investor who just buys random stocks hoping for the best. Did this video cover all of your questions about penny stocks? Do you feel like you're ready to invest now? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.